Okay, so this is my database project for Accounting 311. So the two companies that I picked are Capital One and American Express because both of these companies are used in my household. So for Capital One, they are a full-service bank founded in 1988. They were founded by Richard Fairbank and Nigel Morris. They're known for their credit cards, loans, and banking. And the data years I'm using is 2020 to 2024. And another fun fact about Capital One is that they recently just acquired Discover, which is another huge bank. So for all the ratios, I'm going to use the profitability ratios. Profit margin on sales is net income divided by sales. Return on assets is net income divided by total sales. Earnings per share are net income divided by shares outstanding. And return on common stockholders' equity is net income divided by common equity. So the liquidity ratios, unfortunately, since I'm doing a bank or a financial place, they are not able to use the liquidity ratios because they don't report ACT, which is current assets, or LCT, which is current liabilities, since it is a banking data set. But I did want to show it just because they are very important ratios to know and be able to use. Then the activity ratios, accounts receivable turnover is sales divided by receivables. Asset turnover is net sales divided by average total assets. And inventory turnover is cost of goods sold divided by average inventory. I also cannot use the inventory ratio, but I did think that it was very important to show. Then for the coverage ratios, debit to asset ratio is long-term debits divided by total assets times interest earned is EBIT divided by interest expense. Cash debit coverage is operating cash flows divided by long-term debit. Book value per share is CEQ divided by shares outstanding, and year-over-year change is ending value divided by beginning value minus 1, and then free cash flow is operating cash flow divided by, or minus, net increase in earning assets. So then for the Capital One financial analysis for profitability, profit margin on sales was 8.59%, 38.68%, 19.18%, 9.88%, 8.80%. As you can see, this one jumped up in 2021 and then gradually went back down. Then the return on assets was 0.64%, 2.87%, 1.62%, and 1.02%, and 0.97%. Then we have the return on common stockholders' equity, which was 4.90%, 22.05%, 15.42%, 9.18%, 8.49%. This one also did the same, jumping up in 2021. And then earnings per share was $5.91, $29.94, $19.30, $12.85, and $12.45. Then for profitability, the price-earning ratio was 17.7, 5.03, 4.96, 10.7, and 15.3. Now for the payout ratio, the current dividend payout ratio is 61.91 for Capital One, and this worsened by 131.38% from its 3-year average of 26.08%. Then this is where the liquidity ratios would be. I unfortunately don't have those since it is a bank. Then we have the activity analysis. So the accounts receivable turnover was 13.3, 14.7, 15.1, 16.1, 17.2, and the asset turnover was 7.1, 9.72, 10.6, 10.3, and 11. As you can see, both of these did gradually grow. The asset turnover one did fluctuate a little bit, but it still grew. Then for the inventory turnover, I unfortunately cannot use that one since banking does not produce or sell like actual physical goods. Then we have the coverage. So the debit to assets was 18.38%, 8.40%, 8.37%, 9.09%, and 7.50%. And then the times interest earned was 4.67, 25.78, 6.75, 2.97, and 3.3. The reason 2020 is higher for some of these might be because of COVID and the aftermath of it, but then we have the coverage again. So for cash debit coverage, it was 47.3, 34.5%, 31.4%, 47.3%, 49.4%. And then for the year-over-year growth, 2021, there isn't anything. For 2022, it was negative 27.1. 2022 was negative 9. And then 2023 is 50.7, and 2024 is 4.4%. The reason some of these are negative and some of these are positive is because when the cash debit coverage goes down, the percent is going to go down too. And then you can see from 2022 to 2023, there was a pretty big jump, which is why the year-over-year growth was pretty high. Then we have the free cash flow bank style. So it was negative 12.34. For 2021, it was 2,356, then negative 17,506, 2,867, and then 9,174. And then the value per share was 120 and 61 cents, 135 and 76 cents, 125 and 19 cents, 134 and 97 cents, and 146 and 73 cents. So the reason that 2020 and 2022 were negative means that the bank increased its earning assets, which is like the loans and securities, more than the operating cash flows. And then it's the opposite for why the other ones are positive. So for Capital One's financial health trends, the profit margin on sales was highest in 2021 at 38.68%. The return on assets was the highest in 2021 at 2.87%. The asset turnover was highest in 2022 at 10.6, and the book value per share was highest in 2024 at 146 and 73 cents. Then the cash debit coverage was the highest in 2024 at 49.4%, and the year-over-year was highest at 2023 at 50.7%. So this is a graph showing the profit margin on sales. You can see that it was going up pretty good, and then it just it slowly started to drop. This one is comparing the profit margin on sales to the return on assets. As you can see, as the profit margin on sales goes up, you can see it slightly goes up on the return on assets, but not by a lot. Then for the cash debit coverage versus the year-over-year growth, you can see that when the cash debit coverage decreases, the year-over-year growth decreases, and it kind of just depends on how much the previous year was, on how much the year-over-year is going to change. The next company we're going to talk about is American Express. So it's a financial corporation founded in 1850 by Henry Wells, William Fargo, and John Butterfield. They issue credit cards, process payments, and provide travel-related service worldwide. So for the profit margin on sales, it's 8.21, 18.46, 13.51, 12.43, and 13.65. Then the return on assets is 1.64, 4.28, 3.29, 3.22, and 3.73. Both of these had a big jump in 2021, but went back down. Then we have the return on common stockholders' equity, 13.64%, 36.34%, 30.41%, 29.85%, and 34.43%. Then in the earnings per share, it was $3.83, $10.59, $10.11, $11.58, and $14.43. As you can see, both of these are pretty much growing. Then we have the price earnings ratio. This was $30. Oh, my apologies. 30.2, 15.6, 14.5, 16.4, and 21. And then the payout ratio for American Express, the current dividend payout ratio stock is 21.14%, and this worsened only by 2.96% from its 3-year average of 20.53%. Then the liquidity ratios again that we are not able to do. Then we have the activity ratios, which is the accounts receivable turnover, which is 23.64, 21.80, 32.47, 35.14, 36.05, and the asset turnover of 1995, 23.22, 24.47, 25.80, and 27.33. Then we have the inventory ratio, we again cannot compute. And then we have the debit to assets ratio, which was 16.48%, 13.58%, 15.34%, 14.72%, and 14.03%. Then we have the times interest earned, which was 9.70, 48.43, 14.23, 5.75, and 6. Then we have the cash debit coverage, which was 17.3, 57.2, 60.2, 48.3, and 36.9. And 2021 and 2022, these were drastically high. And then the year-over-year growth in 2021 was 230.6% because of that big jump between 2020 and 2021. Then 5.24%, negative 19.3, and negative 23.7. They're just negative because the cash debit coverage was decreasing. Then we have the free cash flow. This one is not banking style, and it was $4,112, $13,007, $19,223, $16,994, $12,133. Then we have the book value per share, which was 28.55, 29.14, 23.22, 38.81, and 43.11. So then we have the American Express health trends. So the profit margin on sales was highest in 2021 at 18.46. The return on assets was the highest in 2021 at 4.275%. The asset turnover was the highest in 2024 at 27.3. And the book value per share was the highest in 2024 at 43.11 Cash debit coverage was the highest in 2022 at 60.2, and the year-over-year was the highest in 2021 at 230.6. So then you can see in these graphs too that the profit margin on sales was growing up and then slowly dropped, not as bad as Capital One's. And then this is the profit margin on sales and the return on assets. The return on assets are much higher in the American Express one than they were in the Capital One. And then the cash debit coverage versus year-over-year growth. You can also see this with the big change in the from year 1 to year 2, since it was pretty much like a halfway change. So for most financially stable, based off of each, most financially stable, I wasn't able to compute the ratio, so I had to go off FCF, the ability to cover interest, and predictable profitability. Amex is consistently positive with their FCF, while Capital One, it kind of goes back and forth, but it is on average negative. So Capital One's average FCF was negative 3,091, and American Express's was 13,094. Then for most profitable, I had to go off each company's ROA and ROE to show that American Express is the most profitable. So Capital One's ROA was 1.42%, and the average ROE was 12%, while American Express's ROA was 3.23%, and the average ROE was 28.7%. American Express's, their averages of ROA and ROE, they grow, but they grow aggressively, but they're not as predictable, which makes it not as profitable. And then the most secure for investments is American Express due to many factors. Capital One has a lower leverage and higher book value per share, but a negative FCF and a higher volatility rate, while American Express has a consistent FCF and a steady profitability. They have greater financial resilience, which is the reason that they are more secure for investments. And then in conclusion, American Express consistently demonstrates superior profitability and long-term financial resilience, making them stronger and the safer choice compared to Capital One. They have higher profit margins, better return on assets, stronger and more sustainable returns on equity, and higher asset turnover and revenue efficiency. And then these are the references that I use to get all my information.